Talk about two ways to consider risk in hedging. And what we're going to do, we're going to break it down in three different ways. First, we're going to talk about risk based on delta, and then we're going to talk about risk based on a dollar amount or a percentage loss, and then we're going to talk about hedging based on an individual position and hedging based on a portfolio. So let's start with risk based on delta. So, as you know, delta is one of the four major option Greeks. You have delta, gamma, theta, and vega. And delta is the most important of the four major option Greeks because delta measures two things, to me, the very most important two things of trading, and that's risk and probability. Right? So, delta measures your risk of how much you potentially might be able to lose or make based on a 1 point move, and then your probability of success, which are super important. So you want to be able to determine where your risk lie before you put on a trade and your probabilities, and then you want to know as the trade is progressing what is that risk, that current risk, and what is that current probability of success. So let's break this down a little bit and let's go over to this Amazon and let's look at this 30-day trade here. So when you are looking at delta based on a measurement of directional risk, delta for an option is measuring how much that option is going to move based on a 1 point move or a $1 move. So for example, if we are looking at this 40 delta option on this put side here, then this option is going to move 40 cents up or down based on a 1 point move up or down. Okay, depending on what you're doing, if you're buying or selling it, it's going to move 40 cents. So that's the risk associated with that option. Okay? And if you were going to have a bunch of different things on, right? So let's just say you're going to have, let's just, for example purpose, I like to give five. Let's say you're going to have five different underlines. You got Amazon, you got some other stuff in different sectors, different amounts of shares and so forth. And if you beta weight that to the S&P 500, which we beta weight here at the Dorian Way to the SPX, then it's going to make it equivalent as if you just had one thing on. So it combines all these things and it gives a delta based on the S&P 500. So if this came out to be plus 25, what that means is that you would make or lose $25 for every 1 point move in the SPX. So that's delta based on an overall portfolio, beta weighted, and then this is delta based on an individual position based on that delta. So for when you're dealing with options, you can have a delta that's 100, and we'll see if we can see one here. If we go all the way up, we don't see one in this expiration period 30 days, but you can see that you got a 99 here, right? So that's basically moving just like stock, 99 cents for every 100 cent or every dollar. That is what that option's saying. Okay? So when we're thinking about delta as a directional risk, once again, it's how much we'll make or lose based on a 1 point move. And if we are the buyer of something, if we're bullish on something, then what we fear is it going down. That's what we care about, right? Is it going down? Because if it's going up, that's how we make money if we're bullish. If we're bearish, it's the opposite. We fear it going up because that's how we can lose money when we are measuring delta based on a 1 point move. So when it comes to delta based on a probability, then you can see that when you buying or selling something, for example, at this 40 delta, the back of the envelope type of calculation is basically saying that if you're the seller, you have a 60% chance out of 40 delta because it's the inverse when you're doing something out of the money, and if you're the buyer, you have a 40% chance. But actually, technically, it's better for the seller. That percentage is actually higher than 60%, and it's worse for the buyer at expiration. It's usually less than that delta. But for simplicity purposes, we just back of the envelope say, okay, if you're buying at a 40 delta, for example, you have a 40% chance. If you're selling at a 40 delta, you have a 60% chance. If you're buying at a 10 delta, you have a 10% chance. If you're selling at a 10 delta, you have a 90% chance. Right? So that is what you've learned through the basics in the Dorian Way School, lesson 2 and so forth. And that's what we go over all the time when you see us doing trades. We're setting those trades up based on delta, and that's determining our risk when we initiate the trade. So once the trade is on, then we base risk based on the delta zone, right? So we have zones for the Dorian Way. We have 0 through 15. We call it the green zone. We have 16 through 30. We call it the yellow zone. And then we have 31 and above. We call it the red zone. So based on the Dorian Way, we primarily, not always, but we primarily initiate trades in this green zone. Right? We initiate this trade in this green zone. So worst case scenario when we are putting on a trade, the primary Dorian Way is that we have an 85% chance of winning if we sell something at this 15 delta. Okay? And when it goes into the yellow zone, then we start to realize it's a little bit more risk, but doesn't necessarily mean we have to do anything. Okay, it's just like if you see a yellow light, you might, be a little bit more cautious. You might stop, or you might go through the yellow light. Right? It doesn't mean you have to stop. You can, but it doesn't mean you have to stop. But in driving terms, it means you need to be a little bit more cautious, a little bit more vigilant, because it could be a hazard situation. And then you have the red zone. And the red zone for the Dorian Way is where we start to really consider risk, and we most likely will make some type of adjustment. Doesn't mean you have to make an adjustment, right? But most likely we will do some type of adjustment, and we have those type of adjustments that we talk about in lesson 7 of the Dorian Way School, of the roll ups, the roll aways, and the roll outs. And you can determine when to make that adjustment. So for me, I normally try to make an adjustment around the 35 delta. So if I start something at a 5 delta and it becomes a 35, then I'm going to make some type of adjustment. Maybe I've done something a little before it, like a roll up or something like that, but usually I'm going to make some type of adjustment by the 35 delta. If the 50 delta, let me get this to clear real quick. All right, so there we go. If we were at a 50 delta, which is at the money, right, then we have then it's basically about to go in the money, right? So what we're trying to do in the Dorian Way is avoid having to go in the money. So for example, on this put side, this is the in the money area on the put side, and then this is the in the money area on the call side. So if a delta becomes a 31, that's the red zone. Well, we're still quite a bit away from it actually being in the money. So it's given us a chance to be able to, consider the type of adjustment, if any, at that point. And it's going to be a lot cheaper to adjust at, let's say, a 31 delta than at a 50 delta. It's going to be a lot more expensive, because as the options get closer to at the money or in the money, the option is a lot more expensive. They're worth a lot more. So the Dorian Way, we have these zones to be able to protect you and be able to mechanically or quantitatively know where the risk lie, and where it might be increasing. Okay? So for example purposes, if I put this trade on here with this Amazon at a 15 delta, for example purposes, right? That was the green zone. It's now at a 25 delta. Okay? It's at a 25 delta, and that is our yellow zone with 30 days to go. Is that a problem? No, right? But I'm looking at it a little bit more, but it's not a problem to this point. We're only in the yellow zone. Okay? So I don't need to make any type of decisions at this point. But this is a way we kind of determine risk by delta, is by the zones. Okay? So any questions to this point? All right, so Now let's talk about, and that's important to understand. We go over it obviously in great detail in the Dorian Way School, and we talk about deltas all the time. So you want to become an expert at understanding deltas by probabilities and directional risk and so forth. But we can also look at risk and base it on a dollar amount or percentage lost, right? So that's just say that, um, for example purposes, we collected, for easy math, let's say we collected $200 for this Amazon position here. Okay? We just talked about basing risk on a delta level, right? And then determining when to make an adjustment. You can also base your risk on what's to some people consider a little bit easier, is how much you receive based on a percentage of that, of how much you receive. So for example purposes, let's say we collected, this is the cost column here on the TastyWorks platform, we collect $200 for the trade. Okay? We collect $200 for the trade. So if the trade is down three times, so if you go three times that, that's going to equal $600. Okay? So if it's down $600, then that's how you can take your risk off the table. Okay, that's how you can take your risk off the table. Is just saying, all right, I'm not going by a delta. I'm not, going by a zone that Brian just talked about. I'm going by simply how much I'm down on the position from how much I received if I'm the primary option seller. Okay?
Excuse
So
me,
we
Brian.
use we use this type of method. One second, we use this kind of method when we're doing day trading. Yes, yes, sir. Go ahead.
The 600 will be on the P&L open, not P&L day, right?
Correct. That's gonna be. It could be on the P&O day if you first get into it and you're down $600 right away. But most likely, it's going to be on this P&L open area here, right? It's going to be in the P&L
Nice.
open area, and that will make it really, really simple. So what I like to do in concert of this type of thing, and if I'm not doing it for a day trade or some short-term type of trade, right? If I'm doing it based on my portfolio, I like to have this number around, it all depends on your size of the account, but in this demonstration account, it's about $30,000 account. Okay. And this is about a $30,000 demonstration account. And so 600 is about 30 or about 2% of 30,000. Right. So I would have to, if I would have to lose like 50 straight times to be able to deplete this $30,000 if my risk is based on this dollar amount or a percentage or two times or three times or four times. You can do four times, right? If you're okay with that amount and so forth. But what I try to think about risk based on a dollar amount is also the amount of your account, right? So if I want to keep my risk at 2% of the size of my account, then that would be $200, or excuse me, $600. So if I receive 200, that's three times that. If I receive $100 and I want to keep the portfolio, the risk at 2% of my overall portfolio, then that would be six times at this case, right? Um, and that'll make it $600 if I'm okay with that, right? So that'll give me the chance for the trade to play out, right? Give it a lot of wiggle room for it to play out, and then if it hits those numbers, I should be mechanical and just get out of the trade, okay? Just like we teach with a day trade. Okay? So this is if you are the seller, right? So we just talked about how you can measure risk based on the zone of the deltas, how you can measure risk based on a dollar amount if you're the seller. Now, when we're buying something, we can base it on a percentage, right? So the easiest way for the Dorian way is to base it on a percentage. So for example purposes, if we were going to buy a call, and let's just say this call that we bought was $6. Okay? Well, we know our probability at best is 50-50 if we're buying something, or a call spread or a single call or whatever the case may be, a put spread or whatever. If we're buying something, the best probability we can have, regardless if it's deep in the money or not, is 50-50. So what we try to do is understand that our directional move, because when you buy something, that's a directional play. When you buy, what we try to do is get out at 50%. So 50% down. So if I paid $6 for this, I'm going to get out once it's trading for $3. And that's when I say to myself, okay, I say, Uncle, that directional play did not work. So I get out of it. And I'll do the same kind of concept for a call spread or a put spread or a put. So in this case, we turned this into a call spread. Then I'm going to get out once this is down, 50%. Okay, I'm going to get out once it's down 50%. And you can also use that number if you wanted to, because you do not want to wait for expiration. Because if you wait for expiration, your probability is usually going to be less than 50-50. And you don't want that to be the case, right? You want to have at least a coin flipping chance of winning on the trade. So, but if you're the buyer of something at or a little in the money, your probability is around 60% at least, or not at least, but around 60% in general. Your probability of success if you get out before expiration. So let's say you're up 40% or you're up 50% or you're up 60%. That's going to increase your probabilities. But if the longer you wait to get out of something you buy, the lower your probability is going to be. And it could be less than 50-50. As you can see here, TastyWorks is saying this is a 44% chance of winning at expiration. All probabilities are based on expiration, everyone. All the math behind these probabilities are all based on this 30th day. So that is what you want to factor in. Okay, this expected move that we talk about, that's all based on where the option is or where the stock is supposed to be at expiration, plus or minus, let's just say just under $11 here. Doesn't mean it can't move $50 within this 30 days, or up or down, but at expiration it's expected to be plus or minus 10 from where it's currently at. And 68% of the time, or one standard deviation of the time, it lands in that area. So if you understand that and you use that math behind it, it can be pretty powerful. So let's recap really quickly.